We still like some of the IB geared plays, and they have some good cost measures, etc., such as Deutsche Bank, UBS. We like the UK, which is a little bit controversial in this environment from a macro perspective, clearly. We like Barclays, which is trading at roughly 7 times earnings, one of the cheapest stocks. Just to put in context, Goldman is trading at 15 times earnings. Yes, we believe there should be a discount to the US IBs, but it's still too cheap in our view. NatWest, a pure retail bank in the UK, making 18% returns, a very healthy environment. But also some of the Southern Europeans like Intesa are on our list of preferred stocks.
And then your least favorite ones. It looks like you're not too keen on the Swedish banks. You see you're underweight on Handelsbanken, Nordea, and SEB. Can you just flesh out for us what that's the case?
Yeah, from our perspective here, the key issue is that they're quite expensive. The total yields that they pay out are more limited, and there's, from our perspective, just more limited earnings growth. So why should we pay a premium, especially when European banks really post-GFC got their act together and improved their operating leverage, cleaned up their operations, and the gap between the quality Swedish banks and Europeans in continent has materially declined.
Let me ask you about M&A. There's been a lot of M&A this year, some successful, some less successful, but we all hear that scale is important to be able to do the tech investment, etc. So how much more of M&A are we going to see potentially in Europe going forward, given some of the failures that we've seen this year?
I think Italy in particular will be probably still an area to look for M&A, but really in Europe it's going to be more limited. I really don't see where the targets are in terms of the listed companies that we cover. And I also feel that actually if you take a step back, a lot of M&A transactions have failed. And that's unfortunate, but I just not in the camps that we're going to see material M&A in European banks in 26.
Finally, digital money. You were telling me that the European banks are a little bit behind when it comes to this, but there's still a question whether this is a risk or an opportunity going forward. So where do we stand there?
Yeah, in our view, we clearly as investors want limited cost growth. And the banks are very cost conscious. They're growing cost at 2 to 3%, very disciplined, much more than the American banks where we see 5 to 10% cost growth. The question is it right in the long term? Should we be more aggressive in investing, especially around digital money, stable coins, tokenized deposits, etc., considering that there's a lot of changes happening in the payment space. And our concern is, just as we've seen in the auto industry, that maybe the European banks could lag behind on a 5-year view, 10-year views of American peers. And that is a real concern.